Hello, everyone. Welcome to video 5 of chapter 9. In this video, we're going to be talking about registered savings plans. So let's get into the slides. Registered savings plans are special accounts meant to help you save money in pursuit of certain goals. So there's the registered education savings plans to save for your children to go to school. Disability saving plans, saving for a disabled child to help care for themselves later in life, and a tax-free savings account to help taxpayers save for themselves. Um, Topics are covered in this chapter due to allowable income splitting opportunities. Specifically, the education and disability saving plans allow for income to be deposited from me, but the investment income will be taxed in the hands of the recipient, the beneficiary, when they withdraw them later. So it's an effective income splitting strategy. Tax-free savings account, the benefit's not really income splitting because that's just non-taxable income, but it has certain limitations set on it. So contributions to these deferred income plans are not deductible. That's different from retirement savings plans. When I contribute to an RSP, I can subtract it from my income, save the tax now, and pay the tax later when I take it out during retirement. So that's different from RESPs and these other savings accounts. These ones are not deductible. I'm going to earn income, I'm going to pay taxes, and from what's left, I will put aside for my children's education. I do benefit from tax deferrals because these savings accounts are going to generate investment income and they're not going to be taxed until my child is ready for school. Um, and there's tax reduction because when someone's going to school full time, they're likely either not working or earning lower income than perhaps me later in life. So when they withdraw that investment income later, it's likely to be taxed at a lower tax bracket or marginal tax rate because as a student, their income's expected to be lower. And tax reduction in TFSAs because income earned in a TFSA is not taxed. There are other registered plans related to retirement, and we will discuss those in Chapter 10. We're focusing on registered savings plans because of the income splitting portion. So I've earned my money, I've paid my taxes, my non-deductible contributions get put into the account. While the money is in the account, their investment income is not taxable. It's tax-free for however many years it takes for the recipient to get old enough to withdraw it. When I withdraw from a tax-free savings account, those earnings are paid out tax-free, but RESPs and RDSPs my contributions are paid out tax-free, but the earnings get paid as an income tax to the recipient or subject to income tax. So what that means is because the contributions have already had tax paid on them, when they're withdrawn, that portion of the money is still not taxable. So when my child gets ready to go to school and they withdraw some amounts from the account, they will decide at that time how much of that withdrawal comes from the original contributions, how much of it comes from income, and that will allow them to sort of plan their taxable consequences. So the tax-free savings account starting here is in 2009, they started this new account to say people can put away money to invest, to save, and the investment income you earned will not be taxed. So in 2009, the contribution space started at $5,000. So for those who were 18 in 2009, their contribution spaces increased every year. From up to 2012, it was 5,000 per year. Then it was 5,500 per year. For 1 year, it was 10,000. Then it was 5,500. So every year, the available space to contribute has gone up. Once you turn 18, if a student turns 18 later, their contribution space will start accruing that year they turned 18, and they'll get that contribution space every year going on. So if someone's been 18 since the beginning, from 2009, their contribution space in 2024 is $95,000. because they have that 5 plus 5 plus 5 plus 55 plus 55 plus 10. So by 2015, that contribution space was 15 plus another 10, 25, about $35,000. That would have been available to that $36,000 would have been available in 2015. And then continuing this going, it got up to $95,000. When you put money into the TFSA, that counts against your total. So if I put $35,000 in 2015, I would only have $60,000 of contribution space left in 2024. When I take money out of the account, it will get added back. So I've put away 35,000, so my contribution space is 60. Let's say the investments did pretty good, and I'm like, hey, I can take 35,000 out and still leave a bit in the account. When I pull that 35,000 out, it's going to add back to that contribution space. So that 60 will go back to 95. Because these accounts are tax-free, the government has certain controls about what you can invest in. So publicly traded shares, mutual fund units, bonds, mortgages, warrants, and rights. But you can't have shares in a private company, and you can't have direct investments in real estate. I think the reason for this is if I own the company or if I own the rental property, I have a lot of control around how those things make money. So to have those in a TFSA is probably unfair because I would be making decisions to improve income in, say, that business instead of me personally to save the taxes that way. What is allowed, those publicly traded shares, mutual funds, bonds, and mortgages have very set repayment plans. So I don't really have as much control, excuse me, over the income here. I'm relying on the market to get me those returns. Withdrawals are 100% tax-free and are added back to your contribution space in the following year. 50% tax can apply on fair market value of non-qualified investments and prohibited investments. So if someone finds out that I've slipped private company shares into my tax-free savings account, when I get the income, that tax is going to be at a 50% rate. Now, that might, given that 53% is the highest tax rate in Canada, I'm likely my tax rate's probably like 30 to 40%. So when I have that income in my tax-free savings account that's prohibited, it'll get taxed at 50%, probably well above what my tax would have normally been in regular circumstances. So this is to incentivize me not having those prohibited items. Excess contributions are subject to penalty. Make sure you don't put too much into the account. And income attribution rules do not apply to TFSA. We will discuss income attribution later in this chapter, but this is specific for contributions by one spouse to another. So I can put money into my spouse's tax-free savings account. On death of taxpayer, the TFSA is transferred to spouse. There's many rules around when someone passes away. Assets can usually be transferred to the person's spouse with very limited tax consequences. So your spouse can inherit the TFSA from you, but they have to be the designated successor. Now, how is this different from an RSP? The RSP, your earnings are only tax-free while you're waiting. Once you withdraw the money, you pay taxes. So, but the contributions to an RSP are deductible. So when I put money into an RSP, I save the tax now, but I pay the taxes later. Whereas TFSAs, it's the opposite. I pay taxes now, but my future income has no taxes. So RSPs are taxed at withdrawal. TFSAs are not taxed on withdrawal. TFSAs pay their taxes when I originally earned the income. When I contribute to an RSP, that contribution space is lost. I've used it, but TFSAs can get that contribution space back through withdrawals. Okay. Registered education savings plans. These are savings plans meant to help, prepare or get ready for children to go to school. So paying those tuition amounts and covering expenses during studies. So this plan is designated to set aside funds for post-secondary education of a child. The contributions are not deductible. Income earned in plan is exempt from income tax while it's in the account. Tax-free accumulation limited to 35 years once plan is established. So if I start an RESP when my child is born, it's expected that they will go to school and pay tuition amounts before the age of 35. That deadline is extended to 40 years if they have a disability tax credit. But generally, it is expected that if they're going to go to school, they will have done so before they're middle-aged. So the plan becomes deregistered at that time, and it just means that any further investment income is going to be immediately taxable. There's no annual limit, so I can put in as much in a given year as I want, but there is a $50,000 limit for each beneficiary. So if I have one child, I can't put more than $50,000 in. If I have two children, 100,000, etc. And if there's always penalties for excess contributions because they want to make sure you're using these accounts as planned, as expected. So when my child enrolls in an eligible post-secondary education plan, then they're able to withdraw amounts from their RESP. The amounts are restricted by the Tax Act per 13-week period. So that's pretty much per semester to $5,000 for full-time, $2,500 for part-time. These amounts were updated. So $8,000 for full-time students, $4,000 for part-time. So if the RSP account has $32,000 in it, they can pull out $8,000 per semester and cover, a 2-year program. So that's their limitation of how much they can withdraw. That way they don't take everything out at once. But that works because as a student, we want to keep their income in the lowest tax bracket. There's an amendment to the federal budget to automatically open RESPs. These are new tax rules we're not going to test you on, but we are going to elaborate on the education savings grant. So why would I put money into an RESP and not a TFSA to save for later? And the reason for it is when you put money into an RESP, the Canadian government will also contribute to that account. So the education savings grants, I will move forward just calling them savings grants instead of going through the whole name. The federal government will make additional contributions to supplement contributions to the RESP. The basic savings grant is 20% of current year contributions to a maximum of $500. So $500 is 20% of $2,500. So there's no annual limit of how much I can put in, but in order to maximize my benefit from this 20% contribution from the government means I would probably want to put a set amount consistently, $2,500 per child per year in order to get that full savings grant. If unused contribution room from previous years, I can get up to $1,000 of saving grant in a given year. So let's say my child was 9 years old when I started saving. I can put 2,500 in, get their savings grant for this year, and then I can put another 2,500 in to try and catch up the year before. So I can put $5,000 per year for the next few years to not only get the grant that's available, but to try and catch up previous years. But I can't collect more than 20% of $5,000. The lifetime savings grant is $7,200. So if we were to do that number, 7,200 divided by $500 per year is 14.4 years. So I can do this savings plan for 14, just short of 15 years, and to consistently get that savings grant amount. So if I put, so let's say 14 years. So if I put $2,500 in for 14 years, that account's going to have $35,000 plus the 7,200 from that savings grant. So I will have just over $42,000 in the account that will have been earning investment income during that time. So it could be 50,000 by the time my child's ready for school. So that additional savings grant is an automatic 20% return from my contributions, which is not nothing. It's a good return. So that education savings grant is the big incentive for having a registered an RESP, a registered education savings plan. So having the RESP is to kind of get this savings grant to help your child later. Now, if the family's low income, they can get an additional 20% of the first $500. So that first $500 will have 20% for the basic savings grant and then another 20%. So that first $500 has a 40% return. So low income families it really helps low income families put a little bit of money aside to get that return to help their children eventually go to school. If their family income's above 55,000, then that additional grant only 10%. Once you're over $111,000, there's no additional savings grant. You're just getting that basic savings grant. Um, the savings grant are intended for long-term planning. That's why they try to gear it towards small, consistent savings plans. In year in which beneficiary is between age 15 and age 17, the savings grant is only made when the minimum RSP contributions made by December 31st in calendar year in which beneficiary becomes 15. Minimum $100 in annual contribution in any of the 4 years before calendar year. So what this is saying is they don't want people to just, my child's 16, they're going to 16 or 17, they're going to be going to school next year. Here's all of the money I wanted to put into the savings account. They don't want that. They want people thinking ahead and consistently putting away savings. So you don't really get too much savings grant if you're leaving it too late. I'm not going to go too much into the learning bonds. Learning bonds is an additional savings vehicle you can use, but I want to just stop on types of plans. So family plans typically established for several siblings under age 18 to allow for flexibility for subscriber. So my RESP, I can put $2,500 a month for my child. If I have multiple children, I could put 25, 5,000, 7,500. So the family savings plan allows me to put money in for my 3 children. But what if one of my kids doesn't want to go to college? What if they finish high school and then they want to go start a business or go travel? That still allows the money to be available for my other children who do want to go to school. Scholarship plans, all funds must be invested in a government guaranteed investment. So scholarship plans is plans because your plans are often managed by the bank. You could lose money on an investment. So you might go to the bank and say, I want this RESP to be a scholarship plan. So they will only do risk-free investments. It's not going to earn as much income as, a riskier portfolio might, but you can be sure the money's going to be there in 16, 15, 17 years when your child gets of age to go. But if you don't want the bank to handle that, you can put into a self-directed plan where you will choose your own investments. Just make sure they're qualified. And then there's additional points on the educated assistance. I don't want to go into that much detail because I don't want it to be confusing. But we will finish off with comparison to RSPs. So what is the education saving plan differences between the retirement plans? One is they both have tax-free accumulation of earnings in each year. The RESP, the education plan, is great for the accessibility to those saving grants. The payments to students may be tax-free or taxed at low rates. So my child is pulling the money out later, not me. And they can decide, okay, I'm going to take out the interest income up to my basic personal amount. Anything else I need, I will take from the contributions to be tax-free just to make sure I'm not paying taxes in those first couple years of university or college. The RSPs, you get an immediate benefit because my contributions are deductible. So I have an immediate tax savings now, but payments will be taxed at full rates later. So RSPs has the benefit of the savings grants and being taxed at lower rates when my child is of age, and the RSPs have an immediate benefit for deducted contributions, but the payments will be fully taxed in my hands when I eventually retire. The disability savings plan is very similar, The major difference is it's meant to aid disabled children when their parents grow too old to take care of them. So I will put, if I have a disabled child and it takes, there's care and costs related to taking care of them, I'm not going to live forever. They're likely to outlive me. So I want to make sure I put some money aside, help that money grow through their life. And when I'm unable to be there, then they have funds available to perhaps hire support, hire staff, hire medication, special equipment, etc., or to just help them pay their day-to-day expenses. So it's a non-deductible contribution to trust with a disabled person as beneficiary. Earnings and plans are tax-free. Before we had a maximum contribution of $50,000 per child. Now we can contribute up to $200,000 over the lifetime of the disabled person. Payments out of plan are a combination of taxable and tax-exempt amounts, just as before. So I put $200,000 into it. That's the non-taxable capital that I've already paid taxes on those amounts. So those amounts can be withdrawn tax-free. The income that's been earned over the years, that will be taxed when it comes out. So to establish an RDSP for an individual 18 years of age or older generally requires establishing a legal representative. The reason for this is if someone with a disability is in need of one of these savings plans, you might have to designate a legal representative who can make the financial decisions. So when I'm not here, this person can help make financial decisions. They can plan how much money to take out to, get the best tax emphasis, make sure bills are paid, such as like stuff like that. Make sure there's someone capable of helping that money go as far as it can to help my child. Okay, I will go through one more exercise for the RESP. When we come back, non-arm's length is what we're going to discuss. But for the RESP, we want to talk about the Canadian Education Savings Grant. Janine was born in 2023. In 2023, subsequent to her birth, her father established an RESP for her and contributed $500 to the plan, while Janine's grandfather contributed an additional $1,200. So in 2023, $1,700 was put in the plan. In 2024, her father contributed $1,500 and the grandfather added a further $2,400. So that's $3,900 in the next year. Janine's family has never had family income more than 50,000, so we know they are going to get that additional savings grant. Determine the amount of the savings grant that would be added to Janine's RESP in 2023 and 2024. So the basic amount in a given year is that first $2,500, 20% will be contributed up to 500. But in that first year, they didn't put in 2,500, they put in 1,700. So 1,700 at that basic amount, 20%, $340 is going to be added in contributions. So the account will have 1,700 plus 340 from the government for a total of just over 2,040. Because the income is low enough, they're also going to get an additional 20% on the first $500 that was put in. Since we put in 1,700, we're over that amount. 20% of 500 is an additional $100. So they got the basic savings grant of 340, and then they get that additional savings grant of another $100. So the total account will have 1,700 put in plus 440. Our regular savings grant was 340 plus an additional 100. So our account now has 2,140. That's a pretty basic year. Because we didn't use all of that available grant, that $500, some of it will carry to next year. So the carry forward is $800 of unused space. So in the next year, when we put in $3,900, the first $2,500 applies to 2025. We got the 20% of that year. And we also got to catch up a little bit. That remaining $800 we didn't put in last year, we still get the claim. 20% of that is $160. The only thing is that adds up to $3,300. At $3,300, we're caught up. There's no additional basic savings grant available to us. So that $600 that's left will have no grant associated with it. 39 minus 2,500 minus 800 equals $600. So we have the basic amount of 500. We got $160 that we caught up from last year. And then we have nothing going forward. Our income's still low. So we get that additional 20% on the first 500 for another $100. So our savings grant in 2025 will add another $760 to the account. The question doesn't tell us how much was put in 2026, but knowing that we're missing out on 20% of $600, maybe we can talk to the grandfather. Maybe we can talk to the grandfather and say, hey, since you're planning on putting this money in anyway, what if we wait a few weeks or a couple months and put it in 2026 and we can get another $100 in savings grant, $120. So that's a tax planning opportunity for us to say, hey, we're not getting any benefit from this amount. Maybe we can move it to a period where we will have a benefit. Okay. Like I said, in the next video, when I come back, we will discuss non-arm's length transactions. Those are dealing in transactions with people that have a close familial relationship with us, brothers, sisters, parents, or our best friends. We often talk about family members, but friends can be non-arm's length transactions. It's just by not being family members, it's hard to prove that we have a non-arm's length transaction. So in the next video, I'm going to be talking a lot about family members, but just remember, it doesn't only have to apply to family members. Anyway, I'm digressing. Thank you for your time. If you have any questions regarding the RESP stuff, please feel free to send me a message. Until then, see you in the next video.